Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone, it's Liam Garman here, editor of SPI, with my amazing co-host as always,
Emilie, Lauer.
unpacking some really big changes in the world of property, I think.
Yeah, there's been a lot of news happening.
Since our last check-in.
Yes, it's been a while.
It's been a while. We've had, actually, I don't even know if it's one or two rate cuts since we last sat down and unpacked the data, maybe even both. Maybe
I think
both of them
one.
in that time, or one of them. But obviously we've had a federal election as well. We've released our Fast 50 report. Everyone's probably seen us on Instagram.
Yeah, it's been a busy couple of months for the SPI team here at Momentum, yeah?
It has. And look, saying right from the top, we're going to have to give it a plug, the Fast 50 report. What we've done at SPI is we've gone to some of the nation's best minds in property, from networks, buyers, agents, investors themselves. And we've compiled their top 50 suburbs where they expect to see growth over the next 12 months. You can download that report free on our website. So visit www.smartpropertyinvestment.com.au. There's a tab up the top, isn't there, Emilie?
Yes, there is a tab.
Fast 50 tab.
You can just download the report and then you get all the best insight on where to invest next.
For sure.
Which I think it's pretty great that those experts are sharing their inside tips. Free of charge.
Free of charge. And we so basically, look, we give it to some pretty smart people. Emilie and I know a lot about property, but I don't know how your maths is. We defer it to the experts.
Yeah.
And they average out what all of our guest contributors have said, and then they rank it. It's not in a ranking, it's A to Z, whatever the last one is there. But it's ranked, so go online, download that. We've also had the federal election, which, you know, it was pretty decisive. But Emilie, I know you've been house hunting recently. It looks like the market is pretty hot off the back of a pretty decisive election and the rate cuts as well. What are you seeing on the ground?
It is definitely changing. It is intensifying. So everybody's been telling us, yeah, you'll see after the rate cut, demand is going to soar. You know, like there's going to be more people that think it is now the right time to buy a dwelling. And it's true. So I've been house hunting for a little while. It started before the rate cut, continuing after the rate cut. And you could see the moment the rate cut happens, the following Saturday, a surge of people. Yeah. So the reason, I guess, is I don't think everybody is at the time where they can actually buy, but people are curious. So they start coming in to see what their money can buy. And then they start, going through the process of finding their mortgage broker, sorting out their finances, and just, be ready in the next couple of weeks or months, depending on how fast they want to go. But you definitely see a surge in people, and you also see a speed in the terms of how fast those properties are sold. So there was a property we really wanted to see. It was on the market for 2 days.
Yeah.
So we didn't even have the time to go and inspect it. It entered the market on a Tuesday. The inspection was on a Thursday. By the Wednesday, was gone.
Yeah. And I think there's a lot of people that FOMO is kicking in.
Oh, 100%.
And because you're right, there's realistically, you can't get pre-approval in that time. You're not going to get pre-approval in the days following the rate cut. In fact, a lot of second-tier lenders didn't even announce it immediately that they would even be passing on the rates. But we did a recent podcast with a fantastic buyer's agent, Simon Liu, and on that podcast, we were speaking to a mortgage broker as well, who said the second that happened, we were inundated with calls from both a buyer's agent perspective to buy a house, but also from mortgage brokers for people looking to refinance, looking to get new loans out. I do think there is an element of it being FOMO because we've got the rate cuts now, and if we project 1.5% drop in rates, just off the back of that, price is going to increase. I think analysts predict about 12%.
Oh, yeah.
So, and that's only off the back of a rate cut. So we've still got this natural trending up of prices in property. You'll always have a big chunk of the Australian public that will use property as a store of value. And I think it's a fantastic way of looking at it because over recent years, we've seen some pretty high inflation.
Yeah.
Now, those inflation numbers realistically are higher. Because when we get our data from the RBA on inflation, realistically it's higher because we've been given energy subsidies.
Yeah.
The government's come in, handed out money, cash over, hand over fist, which artificially made inflation lower. Realistically, it is higher. And there is a lot of money going through the economy. And a lot of people are putting it in property as a store of value of, hey, at least it won't erode unlike it would in my savings account. So that will always trend prices up higher. Then you'll have 12% off the back of rate cuts. One thing that I know you were very keen on with your property journey and looking for your recent purchasing is, hey, as of, 1 January estimated 2026, we're also going to have a 5% deposit for first home buyers.
Yeah, and this is something that I've been very aware of. And look, as much as the scheme is fantastic for first home buyer, it's putting actually way much more pressure on them and on all the first home buyers within Australia, because it means more people will get into the market, more first home buyer will come, and there's not enough supply. So we're always going back to the supply side of things, which means what is on the market in now or in 6 months' time, it's going to be way much more expensive. And yes, you've got the 5% deposit, which allows you to enter the market, but still, what can you do if you cannot buy the property you want to because it's too expensive? So I think we're going to see a lot of rentvesting coming up.
Oh, for sure. And look, I don't mince my words on this. I'm not sold on the policy yet. Now, I'm a journo, so I've got to actually be, a middle of the road. And I will say it's an opinion. I'm not sold on the policy for the reason that you said. We've got some estimates say by 2029 we're going to be 260,000 dwellings short of our supply projections.
Yeah.
So the government wants to build 1.2 million homes by 2029. Some predictions say we're about 260,000 short. Other predictions say we're going to be 500,000 short. To your point, there's not realistically, given population growth, there's not that much stock coming online. What we're doing is there's going to be a whole heap of new buyers, though, a whole heap of new buyers. And what makes me worried is, yes, prices will go up. Now, prices going up by themselves isn't problematic. What is problematic, though, is in Australia, we've been really lucky that for so many years we've had very stringent lending rules. Those stringent lending rules are the reasons why we didn't have a credit crisis like in the United States, where suddenly overnight, banks looked at their balance sheet and realized, oh my gosh, we're so exposed to leverage, we're so exposed to mortgages. And then suddenly, the second those mortgages devalue, then the value of the banks drops, and suddenly insurance need to bail them out for their subprime mortgages, right? One of the main reasons we avoided that is because we had stringent lending rules. Now, if you're going to say to a whole generation of people, you can get on into the market off of 5%, that's not the problem that I have. It's the fact that if you do only have 5% capacity for a deposit, well, you don't really have a long-term proof of your ability to save. You don't really have a long-term demonstration of your ability to put money away and actually meet mortgage repayments. So, what happens then? What happens when we do have a little bit of a blip in the economy and we have redundancies, we have layoffs, or we have hours being reduced, and there is a whole cohort here of young Australians that might really be impacted because they borrowed to their absolute extent, their absolute length, and they're kind of trapped in a debt trap.
Yeah, no, I agree with you. And look, I think it's something that they will have to take into consideration because a 5%, deposit, yes, it allows you to enter the market faster, but you're going to have to repay a mortgage longer and higher.
Far higher.
I mean, if you do put, and look, I'm not saying everybody needs to put a 20% deposit, but if you put a 20% deposit, you actually borrow less money, and this is already yours. You already bought this, with the 20% deposit, and then you just have to pay the rest. Now, the 5% scheme, I think we're going to have to see how is this going to play out, especially because it's also going to depend in terms of which city people are going to borrow from. So the different properties value, like let's say, in Victoria or in Sydney, the median is very different, yeah? So Sydney is most expensive city in Australia. which means property prices are definitely higher than, in Victoria or in Adelaide, for example. So how do you adjust this in terms of to what extent do you let people borrow with a 5% to meet that market criteria and price?
Of course, it's not uniform across all states, and it's not necessarily the problem of people getting in the market. It's that they actually might be harmed long term, and that's one of the same reasons that and everyone's reasoning is different, everyone's economic background is different. It's also one of the reasons I'm skeptical of guarantor loans, and when I suggest people don't do guarantor loans, I do suggest it because there is, at times, there is benefit of having the bigger mortgage or the bigger deposit straight off and minimising your mortgage. Now, if you're rent vesting, maybe not. If you've got negative gearing, if you're playing that game, maybe not. Maybe you want to take on as much debt, as much leverage as possible, and that is part of your strategy, which is why at SPI, where you always say have your strategy. But when you start off, sometimes I don't advise taking the biggest mortgage as possible, especially if it's your PPOR, because there aren't any tax benefits that you get with it. So, anyway, that is not what we're here to talk about today. That was a bit of a market snapshot.
Well, it links us to what we are actually going to talk about, and it is price increasing.
Yes.
So property prices have been increasing in May to hit a new high record of $809,000 across all dwellings, across all states and territories, which is a 0.39% month-on-month increase and a 4.12% increase year-on-year compared to May 2024.
So all dwellings?
All dwellings.
So that includes units as well?
Units
which would
and
be anchoring
houses.
that 809 figure quite low.
Yeah, but still, like it's all dwellings across, all states and territories. Now, compared to the usual, where over the past couple of months, even years, we had regional areas doing better than capital cities. Well, this has been reversed this month. So capital cities led the monthly growth.
And this, I know, I can see the data you're going to pull up next because Emilie and I have a running argument.
Yes.
And Emilie said a few months ago, she said about 6 months ago, wasn't it?
Yeah.
You're like, boom, I'm going into Victoria. And I'm like, not yet. And you're like, no, I'm doing it now. And
it's coming back.
It's come back.
Yes.
Victoria's back.
Melbourne showed the strongest monthly gain to 0.79%.
In 1 month.
In 1 month.
So there are going to be areas in Melbourne that have blown that out of the water.
Oh, yeah, 100%.
Yep.
They now have a median dwelling price of $782,000. Now, because it's Melbourne, let's take this with a pinch of salt. The values do remain below their peak, so 2.85% below the peak and 0.38% below May 2024. So we are seeing that slow burn recovery, but it is in the recovery direction. So it seems that it's starting to, get back on track.
Yep.
Now, because it's still not back to its peak, Perth has overtaken Melbourne for the first time in a decade.
Wow. Since probably the old mining booms.
Exactly. So now we have a median dwelling value in Perth of $787,000, which is a $5,000 difference, let's put it that way, between Melbourne and Perth. And Perth saw a 0.27% increase over the month. So Perth, growth is getting steadier. So it's not as big as they used to be like over the past 5 years where, prices exploded. We're getting back on the steady side of things, but still on the increase side of things. Similar for Brisbane. So Brisbane saw a 0.24% growth in May to $889,000 for dwelling values, which push Brisbane to be the second most expensive city in Australia after Sydney.
Cementing in there.
Yeah. So people who invested in Brisbane 5 years ago, they saw a 85.3% growth since March 2020.
Now take us through the rest of the capitals. To see as a comparison.
So Adelaide was the second city to have the strongest growth over May, with 0.52% growth. And it had the highest annual growth at 11.04%.
Insane.
Sydney saw a 0.39% increase, Hobart 0.30, Darwin 0.27, and Canberra 0.22.
So it's quite interesting. So we've had all major capital cities grow over the last month. Now, it's very reasonable to say over the last 12 months or how long really you and I have been doing this podcast is that there's always one outlier. There's always one city which goes south. Everything's up here. I would take this as we kind of led into this conversation, it goes back to those macroeconomic factors that we started this off with. You got more lines of capital. You got lower interest rate. You can literally lower interest rate. You can borrow more.
Exactly.
That's going to push it up, and the supply.
Yeah, look, what people are saying, and it's goes back to what we said before. Because of the rate cuts, buyers' demand has been going up, which means supply is going down, which means prices are going up. So everybody's expecting prices to grow further, and in some states faster. Depending on where you are. But yeah, look, it grew also across the regions, 0.25% across regional Australia, which means a 5.19% annual growth.
Nice. Well, we're going to go to a quick break, and when we're back, we're going to go into the world of commercial real estate and rentvesting. So if you're at that point in your portfolio and you need to diversify, if you want some higher yields, stay until after the break where Em is going to take us through the retail sector in Perth. We'll be back in just a second. Liam Garman, Emilie, Lauer from the Smart Property Investment Show. And before the break, we were having a bit of a chat. We start off with the macroeconomic indicators, which lead both Emilie and myself to think there's going to be some pretty strong growth on the horizon for the property market. But Emilie provided a quick snapshot of our capital city growth. Now, the retail sector in Perth. And before you dive in, I know it's been a really big focus on SPI over recent months. Really, and I think it's very fair. So many people have tapped out their resi portfolios, or they're looking for higher yields. Or let's be honest, when you mentioned that the Brisbane market grew by 85% in half a decade. Yeah. For a lot of people, maybe there's not much growth left in some of the resi areas. So we're seeing a real huge diversification into commercial. We've got clients coming in that are talking about commercial. We've got readers that are flocking to our stories and our podcasts about commercial property. So it is something that I do encourage all of our listeners, even if you're typically investing in residential property, to look into.
Oh, 100%. And look, people have told me they moved outside the resi to the commercial because it's so much easier to be a commercial landlord than a resi landlord.
Longer tenancies.
And higher yields.
Higher yields, and your tenants pay for a lot of their upgrades and upkeep.
100%.
So yeah, there are a lot of benefits to it. So take us away.
Look, Perth has been one of the top commercial sector, and especially the retail sector in Perth, and it has been driving the city's performance over the last month, over the last quarter, I should say. And this is also due to a strong population growth in Western Australia. So retail prices grew by 23.8% over the March quarter. That's to $5,238 per square meters. That's a 6.3% annual increase, which is massive.
Yeah.
Now, the inner Perth sub-region had the highest median retail price at $7,500 per square meters. And it has had the strongest demand since 2023-2024 because WA population grew by nearly 3% over the quarter.
Yeah, that's those are some pretty stunning figures there. 28.7% of retail sales were in the 250,000 to 500,000 range. Actually, quite affordable.
It is quite affordable.
That's quite reasonable. And I think one thing that we have to consider here, which is that kind of economic principle of arbitrage.
Yes.
When when you do have more reasonable prices, more reasonable returns in that resi space, investors are going to flock over. So do watch this space. Now, Rentvesting. You've also got some data in the world of Rentvesting.
So look, Rentvesting is starting to become a real strategy, a real investment strategy, especially for first home buyer. That goes back to what we were saying earlier on. Prices are increasing in capital cities, and it's actually for certain area cheaper to rent rather than buying. So people have been looking at Rentvesting way much more, and that has showed a 21.4% increase in a Rentvesting loan. This is twice as fast as owner-occupier's loan, including that 54% of first-home buyer would consider Rentvesting compared to 4%.
That's a lot lower than I thought.
In 2024.
Oh, but up 4, yeah.
Yeah, look, it's up 50% in 1 year. Look, I think there is still I think Rentvesting is a very Australian concept. And I think there's still a lot of hesitation for first home buyers to go onto the Rentvesting side, simply because we've been ingrained, or at least European people have been ingrained, that you're supposed to own where you live and go on to the owner-occupier route. But I think it's starting to become more and more popular. And as prices will go up, I think we're going to see a lot more first home buyer going through the Rentvesting side.
Absolutely. Now, we're going to go to a quick break. And when we're back, we're going to look at those Aussie suburbs where, hold on to your seats, mortgage repayments are cheaper than rent. We'll be back in just a second. It's a team from Smart Property Investment. Emilie, mortgage repayments cheaper than rent.
And
it seems too good to be true.
It is beautiful.
Too good to be true. So talk us through the data.
Well, there is about, so Cotality and Eubank did a study where they found about 500 units and 600 houses market where mortgages are actually cheaper than renting. And that is all across Australia, not only in regional area. So this comes after the median weekly rents has been rising over the last 5 years by 39% to reach $659 per week on a median. Now, the mortgage median repayment are now $922 a week, which is higher, but 7.7% of Australian suburbs have actually cheaper mortgages repayment than renting.
With a 20% deposit.
With a 20% deposit.
Yeah.
So not the 5%. And this is very much happening in Darwin. So in Darwin, you've got 85.7% of suburb that is actually cheaper than mortgages, which is massive. Look, this is happening in other cities also, like Sydney, Melbourne, Brisbane, and Perth.
Give us the suburbs.
So
I know you got them there.
In Sydney, we've got Canterbury and San Remo in the Central Coast. In Melbourne, we've got Melton South and Narre-Warren. In Brisbane, we've got Leichhardt and Zillmere. And Perth, we've got Maddington and Jolimont. And that's it. No Adelaide ones.
That is, well, I mean, Adelaide's had so much growth that we can assume that that would have driven it. And look, Rentvesting is going to be growing, and I think it's something that will only go up for young Australians, especially. If Melbourne starts picking up as well, if Brisbane continues its trajectory, then realistically Australia's 3 biggest cities probably going to price out a whole generation of young Australians.
100%.
And they're going to be looking to put their money somewhere.
What's your take on how is this going to play on the market for investors?
It'll keep driving prices up.
Yeah.
Well, I mean, it will drive prices up in those traditional areas that we would expect. So outer urban or regional, we would expect that would be where people can park their money. Ultimately, Rentvesting would be driven by people that want to protect their lifestyle. So live in a nice area, I don't know, Bondi or Mossman or something, but still park their money in an asset. So they would have to, by necessity, that they're going to have rent. They'd be looking to park their money in low quartile affordability areas, so that bottom 25%, so regional, outer urban. It will just continue to drive it up.
Yeah.
But it won't necessarily you wouldn't necessarily look to Rentvest in the city that you live in.
No.
But you can, but I mean,
but-
you probably just live there by that point. It probably wouldn't meet your needs. So we would expect that it would drive price growth in those outer urban regional areas.
And that cues us to, if you are looking at Rentvesting right now, we've got the Fast 50.
Oh, that's why you asked. That was brilliant. Yes, smartpropertyinvestment.com.au. Go on, download Fast 50 where you will see the top 50 suburbs poised for the biggest growth. But that is all we have time for today, isn't it?
Yes, it is.
Oh, this is actually going to be coming out on public holiday.
It is.
So how many tragics are listening to us? We don't know, but tragic in a good way. That is all we have time for, and we'll be back soon with another Smart Property Investment Show. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.